I think we're getting a lot of this lately where people just say, what's the point? I'm going to own the 5 or 10 biggest stocks. Look how well they've done.
You know what's interesting? I've been thinking about this a lot. That people like you and I that have read a lot about market history and are familiar with chapter and verse an answer to this question, why wouldn't I just put all my money in the best stocks, the biggest stocks, the best stocks? And we've seen, examples of history of why this is never a good idea. What if, and I'm just asking the question, so take it easy. What if everything that we've read has made us less prepared for a future where the past is no longer relevant? That the idea that trees don't grow to the sky. What if these trees do grow to the sky? What if these giant companies have altered the landscape and this is just it going forward? Now, I don't actually believe that.
Right. But this is what everyone is considering now after 10 years of this.
Right.
That's what everyone is trying to talk themselves into.
But the fact that even a seed of doubt creeps into my brain makes me really empathetic to the idea why these questions exist.
Okay.
Because you say like these businesses, again, let's just say that you haven't read all the stock market history and all you know is what you see. These businesses are so entrenched in every single part of our daily lives. All of the giant companies in the past, whether they were industrial conglomerates or whatever, it was a product, it was a car, it was a telephone. Like these companies, Amazon, Google, even Facebook for some people, Apple, they are our life in every single aspect of our life. They were so entrenched. So that's why it's easy to say, you know what? These companies aren't going anywhere. Amazon in 10 years will still be Amazon. Google will still be Google. And I'm sympathetic to that argument. Now, I guess the ultimate question is, yeah, but to what end? Like these can still be the dominant business in 10 years hence, but if investors overpay for them, then you're not going to get a good return on your investment.
I think you could make the case that, like, I think a lot of people are looking for mean reversion for these stocks to drop off. I think you could make the case that these stocks remain the largest stocks in the index.
They just don't grow as fast?
But they just don't grow as fast, or they grow with the index. So I think you could make the case that even if they just stay market weight, that's a huge thing, and then they just stay with the index, and they could stay there for a long time. So DFA had this story last week, and I sent it to you right away because it proved you wrong from what you said last week. Sorry.
What did I say?
Sorry, not sorry.
What did I say?
I said, isn't it always, you said the top 5 stocks are 24% of the index. And I said, isn't it always the case? Maybe we're both right here because it hasn't been like this since like the 1970s.
It's the highest they've been in 50 years. Give me a break.
Okay. From 1927 to 1972, basically the top 5 stocks were a constant 25% of the index.
It was different
which is what it is now.
It was different that time.
Okay. But I'm saying, so if you look at it, they also showed, they looked at the annualized return after becoming one of the 10 largest stocks. After 3 years, you outperform by like 1% a year. After 5 years, you underperform by 1% a year. After 10 years, you underperform by 1.5% a year. So that's not a huge underperformance by any means. But they looked at the 10 largest stocks by decade. And AT&T was up there in the 30s, 40s, 50s, 60s, 70s, even the 80s, and it finally dropped off. I'm saying you could make the case that Apple and Amazon and Google and Microsoft will continue to stay up there, or maybe at least a handful of them will continue to stay at the top, but that doesn't necessarily mean that they're going to outperform as much as they have in recent years, because if not, then they will eat the whole index. So I think it's both ways, and I would not bet against them dropping out of the top 10, but I wouldn't say that they're gonna continue to compound at such high rates of return, because that's impossible. I'll say it. There's no way it can happen.
Well,
the government would break them up, or they would have to break themselves up, or
in 6 years. In 6 years, if this growth continues, in 6 years, these 5 stocks will be half of the index. Okay, so do you want to bet on that, or do you want to bet on? I don't want to say history, but I guess everything we know about how markets work is that competition, erodes their moat eventually, and maybe it doesn't. But again, the idea that they're going to continue to grow at the pace at which they have, I think, is insane.
So DFA they said this is the old norm. So they said AT&T was among the largest for 6 straight decades, beginning in 1930. General Motors and General Electric were ranked in the top 10 at the start of multiple decades. IBM and Exxon were also mainstays, and so they say that the concentration of the stock market in a few large companies is not the new normal, it's the old normal. And I agree with that this is kind of always as it has been. It's just we've never seen a concentration in a single industry like this as much. Is that fair to say? I mean, energy stocks in the 80s a little bit, but they dropped off pretty quick.
Fine, but what about the so let's talk about the next set of stocks. To me, this is wild. There was a chart. So you think about like Shopify, Spotify, Zoom, all the next horsemen. So this chart shows the NASDAQ Internet has a PE of, I don't know, 160.
This chart looks like it's not right to me.
These stocks are never, ever, ever cheap, obviously, but
I don't understand
why does this not look right to you? The prices of these stocks have gone vertical, and the earnings have probably remained unchanged.
I mean,
or gone up a little.
In like 3 months, it's gone from 40 PE to 160. The stocks haven't gone up that much, have they? I mean, the PE ratio on this chart is basically flat-ish or moving around between 40 and 60 from 2011 to 2020, and then it jumps to 160. Something doesn't seem right here to me, unless it's just dominated by one stock or something. This chart doesn't look right to me. I'm saying it's possible this is a chart crime. Reasonable doubt.
There's 88 stocks: Zoom, Zillow, Yelp. I'm reading backwards. I don't know why. Wayfair, Uber, Twitter, Teladoc, Stamps.com, Spotify, Snap.
I did not realize Stamps.com was a public company. I only knew it from hearing it on podcast ad reads.
Me either. Good point. Netflix, all the usual suspects. Grubhub, GoDaddy, JD.com. You know the names. Fine, Ben. Let's just say that it's 100. Whatever it is.
But yes, you're right. There are now other tech stocks that are taking off like crazy throughout this. And this is the inequality of this crisis. E-commerce and tech stocks are going bananas, right? And some of these other businesses that people are still using. So that's why this has been such a difficult crisis for some people and not for others.
Incredible chart, once again, from Sentiment Trader. He said, a wild explosion in speculation. So he showed a chart, which I've never seen before. The NASDAQ volume divided by the S&P volume. So the NASDAQ S&P volume ratio has gone through the roof and is now higher than at the peak of the dot-com bubble. In other words, people are trading NASDAQ stocks like crazy, as we've been talking about for weeks. So if you had to...
How many indicators have there been in the last 7 years that this is it? This is the top in tech? Like, don't you think there's been an indicator like once every 10 days where you go?
Yes.
All right, my cousin said they're putting their whole portfolio into this.
For sure. So you have to take all of these with a grain of salt or sand or whatever the hell it is. But what is undeniable is that people are going bonkers for tech stocks right now. Like, look at the chart of Spotify. Are you kidding me? Of Shopify, of Zoom, and it's not a commentary on these companies or anything like that. And yeah, Ben, you're right. Like these arguments have been made for the last 10 years.
So this does feel like this feels Nifty 50-ish. So in the late 1960s, early 1970s, go-go years, there were these 50 stocks that the PEs just went vertical on, and no one wanted to buy anything else but these stocks. The crazy thing on that one to me is some of those stocks fell 60, 70, 80, 90%. It was like Xerox, and it was also, some blue chip stocks, but IBM.
Well, a lot of them were blue chip stocks because in the go-go years in 1969, all of those stocks got annihilated. And then coming out of that, there was a new bull market. I think stocks made an all-time high in like 72 or something. And investment managers didn't want to get burned, so they bought the blue chips, and they called them the one decision stocks or the Nifty 50, whatever. You can't pay too high a multiple. So it was McDonald's, it was Avon, just blue chip names that were going for 50, 60 times earnings.
But the crazy thing, Jeremy Siegel wrote this. I think he wrote it in the 90s, so it'd be hard to update it. You'd have to update it now. But the prices were so out of whack, and these companies got crushed. But like 30 years later, they still ended up outperforming. So
interesting.
Couldn't that be a similar instance where we see some of these stocks just get so far ahead of themselves that eventually, when the expectations get too high, that they get crushed, but then they still do okay over the long term? Isn't that a possible?
Amazon fell 99%. Now, I don't want to use the best company of all time as a baseline, but it's possible that these stocks have gotten ahead of themselves today, that these do end up being the dominant business of the future, and it just takes 3 years for them to catch up to their valuations, or not, or maybe they just keep going higher. Who knows?
Yes, Amazon is like trying to pick the next Michael Jordan. That's almost not a fair comparison, but I get what you're saying.
Earlier in the show, I spoke about Facebook and Google. Randomly, I probably should have saved it for this. Somebody tweeted, online now accounts for almost 2/3 of advertising and two landlords. Google and Facebook control 60% of worldwide digital real estate. How crazy is that? These charts from The Economist showing the ad spending in the United States by medium. Print obviously just wiped off the face of the planet pretty much. Television shrinking, online exploding, hence Facebook and Google. Amazon is creeping up. Obviously, there was huge news this week about companies boycotting Facebook. If I had to guess, not really knowing much at all about the topic, I would say that this is a very temporary ban and they're going to be back because that's the best platform.
It's a PR stunt, it feels like to me. I mean, you have 2 billion users on Facebook, and how many...
Where else are you going?
Right. So that's why this honestly is not that surprising, because you have 2 billion people on Facebook, and how many people use Google every day? That it kind of makes sense.
Why does there need to be another search engine? Like, doesn't Google have an impenetrable moat? Or maybe for now, maybe they do for now. I feel like Facebook is probably susceptible, but is there really going to be another social media platform
So here's your thing that breaks these up. Eventually, they're either through their own choice or through the government, Amazon's gonna spin out AWS, and Google's gonna spin out YouTube, and Facebook's gonna spin out WhatsApp or Instagram. That's what's gonna have to happen. Is these all gonna have to be standalone businesses again. That's how these companies don't dominate for the next 100 years or whatever. How's that sound?
Yeah.
Can't you see some of these firms getting ahead of that and saying, you know what, we don't want to go through all the regulation and all these lawsuits and stuff. Let's just do it on our own.
Doubtful.
Okay. Yeah, I guess that's giving them a lot of credit.